It's time to talk about contracts involving insurance and indemnity. Something you need to know is the concept of indemnity, which is an agreement to protect another from loss or liability. The agreement can be a contract all unto itself, or it can be part of a larger contract. When an indemnity agreement is a contract all by itself, that is usually called insurance. An example of indemnity being part of a larger contract would be a construction contract. A home builder, for example, will sometimes agree to indemnify the homeowner from loss caused by the builder. So, if the builder accidentally sets something on fire, or kills somebody, or fails to pay a subcontractor, then the builder's indemnity agreement might kick in to protect the homeowner. If the homeowner is blamed for something the builder did to hurt someone or something, the builder has agreed to protect the homeowner from that kind of liability. Let's go into a little more detail, and instead of talking about a home builder, let's talk about a pilot. Assume a pilot is hired as an independent contractor, not an employee, to fly a plane, and the pilot's contract requires the pilot to indemnify the plane owner from any liability to a passenger. If the pilot lands the plane too hard and a passenger's back is hurt because of it, and if the passenger makes a claim against the plane owner for medical expenses, then the plane owner can insist that the pilot pay the passenger's medical expenses. According to the contract, if the owner is liable, then the pilot must pay. Now let's change the facts a little bit. Let's say the pilot landed the plane just fine, but at some point during the flight, the pilot told the passenger to shut up and loudly accused the passenger of being drunk. The pilot still has the duty to indemnify the plane's owner, but only indemnify the owner against liability. If the owner is not liable, the pilot does not have to pay. And why would the owner be liable in this situation? What law would make the plane owner liable to the passenger? Conceivably, the owner is not liable under any law, so neither would the pilot have to pay. The words indemnity or indemnify or indemnification are not required for the agreements to work. Other phrases that accomplish the same or something similar are hold harmless and warrant and defend and insure. The law only requires that a reasonable person understand that indemnity was intended. The law does not require specific words usually, even though specific words, help a lot. Insurance contracts and indemnity agreements can cover any conceivable loss. There is no limit except the imagination of mankind. If a person could possibly lose something, then another person could agree to indemnify against the loss, no matter what the loss might be. Gambling is illegal. So what's the difference between gambling and insurance? In many ways, there is no difference. But the law allows insurance because it serves a useful purpose. Cutting a person is illegal unless the cutter is a doctor. Selling marijuana in Texas is illegal unless it is for a legitimate medical purpose. So betting on whether or not a plane crashes is allowed if you own the plane or travel in the plane, not if you just want to make a quick buck. Could a person sell insurance on a horse race? Of course the answer is no, but what if the person owned the horse? It's still no. Legal insurance requires what is called an insurable loss or an insurable interest. A person who buys insurance must be buying it to cover a loss to themselves or to somebody they are connected with. For example, I could not buy insurance to protect a car that I did not own. I could not buy life insurance on a stranger's life. So the question about the horse race becomes, what does a person risk losing by racing a horse? The answer is the person risks either 1, losing a bet, or 2, the horse might fall and be injured. The person has an insurable interest in a horse that they own because they don't want it to be injured. If a person does not want to lose money betting on a race, then they simply do not bet on it. The horse's owner can buy life insurance on the horse and buy health insurance for the horse, but the owner cannot buy gambling loss insurance or gamble. Life insurance can be kind of tricky when it comes to an insurable interest. Most people would understand that a husband can get life insurance on a wife. But can a husband get life insurance on an ex-wife? Can a partnership get life insurance on a partner? A person can get life insurance on an ex-spouse if there is a financial interest between them still. Say, for example, if the insurance was on the spouse paying alimony or child support. The ex-spouse receiving the alimony or child support would lose something if the spouse died. So the ex-spouse has an insurable interest in the other ex-spouse. Business partners can get life insurance on each other because they are financially dependent on each other. They have an insurable interest in each other. There are many types of insurance, and the types are often classified by the loss that is covered. Hull coverage is similar to collision coverage on a car, except hull coverage applies to boats and planes. If a plane owner has hull coverage, then the owner is protected against physical damage to the plane. So hull insurance covers for damage to property, no matter how the damage occurred, and will pay to repair or replace the plane. Although some insurance might have limits on how the damage is caused, generally, property damage insurance will not limit on how the damage occurs. For example, the plane may be damaged in a hailstorm. A plane may be damaged because it got hit by another plane. A plane may be damaged because a bird flew into it. Normally, hull coverage will cover all of that. Flood insurance also covers damage to property, but only if the damage is caused by a flood. And fire insurance pays for loss when the property is damaged by fire. Liability coverage goes by many different names. It could be called malpractice insurance or errors and omissions policy. It is supposed to protect the insured from liability to another. For example, if a plane crashes because of the pilot's negligence, the liability policy is supposed to pay any liability the pilot owes to the crash victims. Unemployment insurance protects against financial loss caused by being fired. Workers' compensation insurance pays an employee when they are injured on the job and have medical bills or lost wages. But there are monetary limits. In the case of hull coverage, for example, the insurance company will not pay more to repair a plane than the plane was worth. Specifically, an insurance company will not pay $30,000 to fix a plane that was only worth $25,000 before the crash. And when a plane owner goes to buy the insurance company will want to know how much the plane is worth, and the company will charge more money if the plane is worth more. Life insurance also has a monetary limit, and the insurance company will charge more money for a $5 million policy than it will for a $5,000 policy. Liability insurance is the same way. If you look at your car insurance, you will see it has a per person and per accident limit. For example, a policy that says $100,000 per person / $500,000 per accident, of course, means that the policy is tapped out once a driver has to pay more than $100,000 for each injured person or more than $500,000 for one accident. If the insured driver has to pay anything more, then the driver must pay it out of his or her own pocket. Every insurance policy has what are called contingencies, or trigger events, which are things that must happen before the insurance company must pay. Obviously, flood insurance requires a flood. Life insurance requires somebody to die, etc. Some insurance is considered supplemental, or excess, meaning it pays when other insurance is used up. In addition to the usual trigger events, supplemental or excess insurance requires other insurance to be used up first. In every insurance policy, it is important to know the parties involved. It's often more than just an insured company and an insured. For example, in a life insurance situation, there could be 4 people involved. They are 1, the insurance company, which is supposed to pay when somebody dies. 2, the owner of the policy who pays for the policy and who chooses the person getting the insurance money. 3. The insured life, that is the person who has to die before the money is paid. And 4. The beneficiary who gets the money. Sometimes the same person could be 2, 3, and 4, but usually not. Let's use an example to illustrate this. Larry Leonard buys an insurance policy to pay his wife in case he dies. In that example, Larry Leonard is the owner of the policy and the insured life, and his wife is the beneficiary. Then let's say Larry divorces his wife. He is the owner, so he can change the beneficiary and decides to change it so his uncle gets the money. Then let's say the uncle dies, and Larry then makes himself the beneficiary. At that point, Larry is the beneficiary of his own life insurance policy. When Larry dies, the insurance company will pay the insurance money into Larry's estate so that Larry's heirs get it when the estate is divided. Funeral insurance, also known as burial insurance, is interesting. It's a kind of life insurance, but the money is usually less than $25,000, which is enough to cover the cost of a decent funeral. And the insurance company can pay the money to a relative who will pay the funeral home, or the insurance company can pay the money directly to the funeral home. Sometimes people buy funeral insurance as part of a prepaid funeral. That arrangement involves 3 parties: the funeral home, the insurance company, and the insured. And let's use a guy named Mort for this example because Mort means death in French. In 1999, Mort chooses a funeral arrangement with a coffin, a tombstone, and a plot at a cemetery. The funeral home could offer to give Mort the funeral Mort wants and offer to have it paid for by an insurance policy the funeral home sells Mort. If Mort accepts and signs the contracts, then there is a 3-way agreement which is diagrammed this way. Mort pays the insurance company on a regular basis while he is alive. The insurance company promises to pay the funeral home when Mort dies, and the funeral home promises to give Mort the funeral he wants. The funeral home might get a commission for the sale of the insurance, just like an insurance agent would get a commission. The funeral home might be an agent for the insurance company. But even if the funeral home is not an insurance agent and does not get a commission, what is the consideration to the funeral home? The consideration to the funeral home is the promise that they will get paid in the future for providing a funeral in the future. The promise of future business is valuable consideration, and the promise to receive insurance benefits in the future is valuable consideration. The funeral home might even be willing to discount its price a little in 1999 because it wants the assurance of a steady business in the future. The parties to this insurance contract are 1. The insurance company, which is supposed to pay when Mort dies. 2. Mort, who's the owner because he pays for the policy and chose the funeral home to get the insurance money. 3. The insured life, Mort, again. And 4. The beneficiary, which is the funeral home who gets the money. In workers' compensation insurance, the 4 parties involved in the contract are 1. The insurance company, which is supposed to pay when a worker is hurt on the job. 2. The owner of the policy, who pays for the policy, and is often the employer, that is the company that hires the workers. 3. The insured is the employer again, the company that hires the workers. And 4. The beneficiaries are the workers who are injured, if there are any. Let's talk about property insurance, such as hull insurance, and introduce the idea of subrogation. In this example, the insured's name is Samantha, who bought hull coverage on her helicopter worth $25,000. Her insurance company will be called All Hull Mutual, just for fun. So these are the parties. 1. The insurance covering the helicopter is All Hull Mutual. 2. The owner of the policy who pays for the policy, which is Samantha. 3. The insured is Samantha because the insurance covers her helicopter. And 4. The beneficiary is Samantha. In our example, Samantha's helicopter is hit by a guy driving a car on the tarmac negligently. The insurance company, and the helicopter is just sitting there doing nothing. To keep it simple, Samantha's not even sitting in the helicopter. It's just tied down to the tarmac. And along comes a guy driving a car and hits the helicopter. Samantha's insurance company determines it would cost $30,000 to fix the helicopter. which is only worth $25,000. So All Hull Mutual pays $25,000 to Samantha and gets the wrecked helicopter. All Hull Mutual basically buys the helicopter from Samantha. When the insurance company pays Samantha, the insurance company gets the right to sue the driver of the car that hit the helicopter. All Hull Mutual can file the lawsuit in Samantha's name. It is sometimes said in these situations that the insurance company steps into the insured's shoes. That's the idea of subrogation. The point is that the driver of the car is the one who should really pay, so All Hull Mutual gets the right to make the car driver pay. If the driver of the car had liability insurance, then the driver's insurance company should pay All Hull Mutual. But first, All Hull Mutual will need to convince the liability insurance company that the car driver was negligent. Subrogation works whether or not the property insurance company pays to have the property fixed or pays to have it replaced. It works even if it's not a property insurance company. It could conceivably work for a liability insurance company, a workers' compensation insurance company, any insurance company that pays a loss for an insured steps into the shoes of that insured to possibly sue the responsible person. Subrogation is created by law. It might be in the contract, that is, in the insurance contract, but it is created by law. The fact that it's in the contract is just extra. The insurance contract might actually have a provision in it prohibiting Samantha from signing any release giving away her right to sue. All Hull Mutual will want to have her right to sue and do not want her to sign it away. Because they're stepping into her shoes, they want her to have that right when they step into her shoes. Regarding liability insurance, be careful that you understand who the insured is. The insured person is the person who is accused of liability. In the example with Samantha's helicopter, the car driver is accused of negligence and is the target of All Hull Mutual's lawsuit. The driver of the car has liability insurance and needs that insurance to protect him from liability. Even though the liability insurance may write a big check to All Hull Mutual, the check is written to protect the car driver. The liability insurance is to protect the car driver. That's the insured. The insured doesn't get the money, but they're still the insured. Also, you need to know that liability insurance does not simply pay for liability. It also pays for a defense. The liability insurance company will either pay All Hull Mutual or hire a lawyer to defend the driver. The law requires liability insurance companies to defend their insureds with good faith. Insureds can and often do sue their insurance companies if the insurance companies do not defend in good faith. That should suffice it for now. We'll discuss this more later in the semester. Let me know if you have any questions. Thank you.